Now that we understand the scenario, always important, have a plan of action. You don't have to write this down, but you need to be able to follow this in your mind. Remember, this is part of your exam technique to ensure that you score maximum number of marks in a question. Right. Step 1, draft your templates in terms of your notes. Remember, we need to include our income tax expense note, we need to include our PPE note, and we need to include our investment property note. Right. Step number 2, due to the fact that we need to include our income tax expense note, I'm going to draft my tax calculation templates as well. Remember, my current tax includes all of the details in terms of my scenario. Then I have my deferred tax. Now, if I think about the scenario, remember, we have property 1, property 2. Each of them consists out of land, land and buildings, with quite a lot of different rules here to follow. I'm going to include my deferred tax templates, or a template for each of these sections: land, building, right? Therefore, when you look at my right side of the screen, current tax calculation at the top, and then my deferred tax calculation, I look at this: property 1, land, property 1, building, property 2, land, property 2, building. Very, very important. My suggestion, start on a new page for each of these. Leave sufficient lines open. Okay. Then before we move on to step number 3, I want to highlight something to you. If you compare the notes of property, plant and equipment with investment property, and you look at your columns, in terms of IAS 16, we need to split our assets, land, buildings, all of the different categories. In terms of investment properties, we add our land and buildings in one column, right? Do you see this? Very important. Then another important thing to identify: transfer from investment property, transfer to property, plant and equipment out of investment property, and then transfer to investment property from PPE, transfer from PPE in investment property. Please remember that this should be at fair values. Important. Right. Now, step 3, you need to refer back to your scenario and work through the scenario line by line. You need to tick off all of the amounts used. Remember, have a structure. If you have a structure, you will be able to score maximum number of marks. And then step 4, transfer all your calculations to your notes. If you're not going to transfer your calculations, they're not going to mark the calculations. The requirements state that you need to prepare the notes. Remember to leave sufficient lines open to be able to add smaller calculations in your templates, and then please make sure that you reference all of your calculations clearly. Right, now I'm going to assume that you have drafted your template, step 1, step 2, that you have worked through the scenario line by line. Now I am going to look at the solution with you and explain all of the relevant principles. I'm not going to transfer everything to the notes. I assume that you will be able to do this. Right. Now, our templates. I want to look at my deferred tax. Now, if we look at property 1, remember property 1 was PPE. We have PPE transfer to investment property. Now, if you think about your deferred tax calculation and your rules, remember we need to include the notes for 28 February 2022. We need to include an opening balance and a closing balance. Now, in terms of our opening balance, our carrying amount for our land property 1, if we refer to our columns, we will have to include a carrying amount for our accounting purposes, tax-based tax rules, temporary difference, and a deferred tax. Now, if we look at our carrying amount for accounting rules, remember our land is recognized based on our revaluation model. Therefore, if we refer to the scenario, we should be able to identify on acquisition date, which is 1 January 20.17, we have a cost of 480,000. And then at the end of 20.21, if you think about a timeline, we have 1 January 20.17, our year end 2021, February year end, and then 2022, February year end, right? Now, if we look at 2021, the value will now be at the 840,000. Therefore, we have the 480,000. This should now be 840,000. Therefore, there is an adjustment of 360,000, a revaluation surplus, because our land is based on our revaluation model. Right. Therefore, we are able to identify in our deferred tax calculation that we have our cost, 480,000, and we have our revaluation surplus, 360,000, therefore a total of 840,000. If you look at the the scenario, our 840,000 total. 840,000 total. Now, in terms of our tax rules, the tax base of our asset will be the amount deductible in future against any future economic benefits. Now, for tax purposes, when we sell this land, we will be able to deduct our cost. Therefore, we include the cost. Now, our temporary difference will be the carrying amount minus our tax base. But important, we've identified in terms of IAS 12 paragraph 51b that our revaluation surplus will be taxed based on our CGT rate. Look at this, 80%. Therefore, the 360,000 times 80% will be 288,000. Now, deferred tax asset or deferred tax liability. The carrying amount of your asset exceeds the tax base. Look at this, look at the left side. 840,000 is greater than 480,000. Therefore, this will be a deferred tax liability of 83520. Right. Now, if you look at our timeline, at the end of 28 February 20.21, we have land valued at 840,000. Now, on date of transfer, the value will be 900,000. Therefore, we have a 60,000 adjustment, fair value adjustment. But we call this a revaluation because this is land. Therefore, you will be able to identify that we have our 60,000. This is the 900,000 minus the 840,000. This is a revaluation. It's land. Therefore, for accounting purposes, we have an adjustment of 60,000. For tax purposes, we do not have any adjustment because this is a tax rule. And then our temporary difference, again, will be based on 80% CGT. Then the 48,000 times 29% will be 13920. Therefore, our carrying amount on date of transfer, which is 1 August 20.21, will be the 900,000. Right. Now, at year end, in terms of our investment property, we need to measure our investment property at fair value. When you look at our timeline at the top, measure at fair value. Now the fair value of our land is 1080. When you look at our scenario, they've indicated this to us. The fair value at the end of 2022, 1080,000. Therefore, there will be a fair value adjustment to the value of 180,000. This will be the 1080 minus the 900,000. 180,000. Now, this is investment property carried at fair value. Therefore, the temporary difference will be based on our CGT rate. For accounting purposes, the carrying amount will be the 180,000. For tax purposes, 0 in terms of the 180,000, because this is an accounting entry, it's not a tax entry. And then for temporary difference purposes, it's 180,000 times 80%, 144,000. And we have a deferred tax liability. Right. Now, when we look at the carrying amount for 28 February 20.22, our deferred tax liability will be 139,200. Now, let's take it one step further, and we need to look at our building. Similar principle, we need to determine our opening balance for deferred tax purposes in terms of the building, and our closing balance. We need to identify the movement. If you look at our timeline, we will have to determine that there will be depreciation for this portion, which will be March, April, May, June, July. We are looking at 5 months, right? Then we will determine the carrying amount of our building. We will obtain the fair value, and there will be a revaluation surplus adjustment for us to be able to carry that PPE item out of PPE and take it to investment property at fair value. Right, now, when you look at our deferred tax calculation in terms of our building, we have a carrying amount at the beginning of 2022, which is 28 February 20.21, and this is the cost. If we look at the cost provided to us, I'm going to make use of light blue, 1681920, useful life 25 years. So if you look at a timeline from 1 January 20.17 to year end 20.17, which is February, this is 2 months, right? 20.18, 19, 20, 21, therefore 12, 24, 36, 48, we are looking at 50 months that has passed. Okay, our total useful life will be the 25 years times 12 months, and this is 300. Now, out of the 350 has passed, we are able to take out, which is our accumulated depreciation, right? Therefore, we are able to identify, when you look at the calculation C 2.1, 1681920 divide by the 300 months times 250, and we will be able to calculate carry amount of 1401600, 1401600 for accounting purposes. But what will the tax base be? Remember, this is an admin building. What will the tax base be? 0. There's no allowances in terms of tax, right? Therefore, our temporary difference will be carrying amount minus tax base, and this will be 1401600 based on 100%. Manner of recovery at this point of time will be through use, and no deferred tax, exempt. Then depreciation, which will be the 1681920 times 5 months. Remember, if you look at our timeline at the top, we have identified that this will be 5 months from 1 March 20.21 until 1 August 20.21, 5 months. Therefore, times 5 over 300, and this will be 28032. Therefore, on date of transfer, which will be 1 August 20.21, we have a carrying amount of 1373568. Carrying amount minus tax base 1373568, and this will be exempt. Very important. Apologies, when you look at this arrow, it should be there. Right? Okay, so this will be exempt. Now, next. On date of transfer, the carrying amount will be the 1.3. But we need to transfer this asset at fair value. Therefore, we will have a revaluation adjustment 546432. If you look at the scenario, they've indicated this to us. 546432. Look at this, guys. Right. Therefore, this is our revaluation adjustment, but you would have been able to calculate this if you had to include only your fair value, which is the 1920000, which they've provided to us. If you look at this, our fair value on 1 August 20.21, 1920000. Therefore, again, on date of transfer, determine number one, what is the carrying amount in terms of your PPE, and what will the fair value be on date of transfer, and that difference will be your adjustment. Right, 546432. Now, is this a tax adjustment? No, therefore 0 in terms of our tax, and we will have temporary difference of 546432. 100%. Why 100%? Because our manner of recovery is through use. Therefore, temporary difference times 29%, 158465. Deferred tax liability because the carrying amount of your asset exceeds the tax base. Now, transfer to investment property. At date of transfer, you will remember that they have indicated to us, if you look at the last line item, on the date of transfer, the correction of deferred tax resulted in a decrease in the deferred tax liability of 103230. Now, if you think about this, if you look at my solution, my deferred tax liability is included as a negative. Therefore, if we have a decrease, we will have to add 103230, and this will be our deferred tax liability, right? Therefore, in our calculation, look at the correction of deferred tax line for me, please. Correction of deferred tax line 103230. Okay, but take this one step back for me, please. If you look at my calculation, important to identify, the balance of your deferred tax on date of transfer will be based on use. Therefore, only the 29%. But now, this will be investment property. Remember, investment property will be based on our CGT rate. Therefore, we will have to include this, the before transfer, when this is PPE, to an after transfer amount, where this is investment property. And that will be the 103230. When you look at the calculation here at the bottom, we have an amount before the transfer, when this is PPE, manner of recovery is through use, therefore only 29%. But after transfer, manner of recovery will be through sale, therefore 80% times 29%. And this will be a decrease in our deferred tax liability. Okay. Now, again, if you look at a timeline, at year end, 28 February 20.22, investment property should be included at fair value. Therefore, at year end 2022, if you look at the information provided, 2040000. Therefore, we will have a fair value adjustment from 1920000 to 2040000. Fair value adjustment of 120,000. This will be then based on CGT rate, because this is investment property, 96,000, 120,000. Let me write this down, times 80%, our deferred tax liability. Therefore, our deferred tax liability at the end of 2022 will be 83075.